because the important thing basically now is that what can you do today? I mean, and I'm going to click. There are 3 keys that we said we would give you to take away from this, and the 3 keys are around asset management, investment returns, and transparency. So the issue is, in the asset management business, there are 2 sides to it. Okay, on the one side, it's a profession, and on the other side, it's a business. On the professional side, the goal is the intelligent management of an investment portfolio for superior long-term returns. On the business side, the goal is to gather as many assets as possible to generate fees which create profits for the investment firm and its stockholders. There is no better example, okay, of the business of investing than the mutual fund industry. Todd mentioned that there are 150,000 strategies out there to pick from. These top 50 firms dominate the mutual fund industry. The top 50 firms alone control 90% of all the assets, which is over $10 trillion. The top 5 firms control 45% of all the assets. So the issue is, we tell everyone, this basically is a very, very important and considered decision in terms of whether you're dealing with someone who's in the profession or whether you're dealing with someone who's in the business. The next factor is investment returns. There are 2 major components of investment returns. One is skill, and the skill of the asset manager, and you were hearing about that this evening. And the other is the cost that you pay to have those assets professionally managed, and that can include the advisory fee as well in putting things together. Now, the issue is the fee that you pay for active portfolio management should reflect unique insights and abilities that can produce superior returns over time. As John Lekumnik was saying, superior returns do not come in a straight line. Okay? Every skilled manager will have periods of underperformance, and that is to be expected in portfolio construction. The next thing, basically, and I want to remind us about what Einstein said about compound interest, because he called it the 8th wonder of the world when I talk about cost. Very simply stated, the single best way, and you were talking about this, the single best way to improve returns is to make sure that you're receiving value for the fees that you are paying. This is an 8% return on $100,000, okay? Over 20 years, it's $432,000. If I subtract 2% in fees from that return, okay, that return is now reduced to $303,000. That lack of compounding basically ate up 30% of the return. Last, and the thing that, as I said before, you as individual investors have got to take more resolve for, is the word transparency. Now, before I talk about transparency, I want to talk about the word trust a little bit, okay? Because one of the questions that has to be asked, and everyone is asking these days, is who can I trust? And the right answer is probably no one. Okay? And I say that tongue-in-cheek. I think that given everything that has happened in this industry, everyone should absolutely clean the slate as it relates to the word trust. And I don't care if you've been dealing with someone for 20 years or if you're going with a new firm tomorrow. The reality is, if you're an existing firm should re-earn your trust, and anybody new should be forced to gain your trust. And the reality is, when it comes to trust, okay, the industry itself will tell you that they are very transparent. I've got props I got to show you very quickly. But the industry talks about transparency, and what they say is they do everything that is legally required by them to divulge and disclose as much information as possible. And this is a summary prospectus, okay, and basically it'll tell you about the fees, it'll tell you something about the management. But the key paragraph is at the end. Payments to broker-dealers and other financial intermediaries. If you purchase shares through a broker-dealer or any other intermediary, such as a bank, the fund and or its affiliates may pay the intermediary for the sale of the fund shares. These payments may create a conflict of interest by influencing the broker-dealer and your financial advisor to recommend one fund over another fund. A fairer representation of this statement would be to take the word may and change it to will. Okay? So basically, this is the prospectus. about 8 pages long, the summary prospectus. If you want to find out about these arrangements, you've got to go to the summary of additional information. This is 125 pages long. If you happen to have a variable annuity, okay, and you want to find out, you go to this document, and this is 1,100 pages long. So the point in fact is, they are being transparent. They are living up to the letter of the law, and James referred to this earlier. This is all legal, but they are certainly not making it easy for you. And that's what I talked about when I said that you've got to show more resolve on your own. These are the questions that you want answered, and you can get these questions answered, and you should not do business with anyone that does not answer these questions. Okay? Who are you doing business with? What are the fees and costs for having the assets professionally managed? Are there any, quote-unquote, arrangements between the asset manager and the broker-dealer distributor? And what's going on with the advisor? Let's take them one at a time. Who are you doing business with? In this business, there are wealth managers, financial planners, financial advisors, investment advisors, blah, 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 blah. But the reality is there are only 2 legal definitions. One is a registered representative, and the other is a registered investment advisor. A registered rep is someone that works for or is affiliated with a broker-dealer. The important language here is they are held to a suitability standard as a standard of care. A registered investment advisor is somewhat more independent, okay, and they are held to a fiduciary standard. This whole situation, the standard of care situation, is an absolute mess. If I tried to stay here and explain this to you tonight, we'd be here till midnight. I mean, theoretically, the SEC is dealing with this now, and I would not hold my breath. But the point in fact is, you should know which legal entity that you are dealing with. The next thing, basically, is the cost associated with mutual funds. There's an expense ratio, which is expressed as a percentage, and that percentage is deducted from your assets every year. The lower, the better. And the thing you've got to particularly be on guard about is a thing called a 12B1 fee. A 12B1 fee, even though it's embedded in the expense ratio, has nothing to do with asset management. What it is an ad hoc sales charge that is hidden, that is basically used to pay the advisor and the distributor, what was referred to in that prospectus earlier. There are 12B1 fees right now that are as high as 1%. Okay? This is another thing that the SEC is supposed to deal with, and I wouldn't hold my breath on. The other thing you've got to watch out for is portfolio turnover. Portfolio turnover increases transaction costs and increases tax liability. There are studies that have just been done that say that portfolio turnover and transaction costs are a greater drag on performance than the expense ratio. Separate arrangements. Okay, what separate arrangements exist between the asset manager, okay, and the broker-dealer distributor? The thing you want to look out for is revenue sharing. Revenue sharing is a direct cost where the asset manager is paying for shelf space to get on the broker-dealer's platform. The other thing that is more indirect subsidies are directed brokerage commissions and soft dollars. I'm not going to get into these things. I'm not going to try to explain them. Just think about 2 words: pay to play. That's what these arrangements really represent. And last, okay, what's going on with the advisor? With the advisor, okay, there are 3 questions that you want to ask. And you need to get the answer to all 3 of these questions. The first one is this: how are you being paid? Just sit there, look them in the eye, and say, tell me how you're being paid. Don't go through what happened in The Big Short, where you've got to say, okay, I like the deal, now how are you screwing me? Okay? Just ask them the question and get the answer. Okay? And there's a lot of ways. It can be a fixed fee. It can be a fee on assets. It can be a commission. It can be a 12B1 fee. It can be a combination of things. They're getting paid. I'm getting paid. Okay? We're all getting paid. Find out how we're getting paid. Very, very important. The next thing is this: how are you held accountable for your investment recommendation? That's all I have to say. How are you held accountable for the investment recommendation that you're making to me? Okay? And my favorite, okay, and very simple, are you putting any of your own money in the recommendation that you are making to me? That's my favorite question. My favorite question is your mother-in-law putting any money in the investment recommendation that you're paying to me? Okay? So basically, you've got to understand this. Trust flows from transparency. Okay? If you want to work with someone you trust, you must demand, okay, that they deliver transparency. And I'm telling you, if you take nothing out of this meeting other than those 3 questions I gave you, they will be a very positive step for you in getting those questions answered. You know, we go so far as, you know, we think it's so important that we actually created our own software program, okay, to put together a thing we call a portfolio expert. It's actually alluded to, you know, on the back of your literature there from that standpoint. You know, we're like, you remember the Cy Sims commercials? Okay, well, our attitude is, you know, our best client is an educated investor, okay, from that standpoint. And we demand that everybody we do business with goes through this transparency analysis before we do business with them, so they can understand everything that's going on. Listen, I want to thank you very much for coming. Okay, this was our inaugural event. We appreciate it. I hope if we don't get a chance to meet you before this, I hope that we'll see you again on our spring symposium, okay, which we're also planning to do. And make sure you check in with James on the way out and get that book signed. It is a wonderful book, I will tell you that. Thank you very much.